Hello to a beautiful Thursday on Crypto. Oh my God, today it's just all about Bitcoin. We are in the middle of a crazy rally, and let's just try to understand, do we go up or do we go down? Boom. Before I hop into the meat here, you know I love to talk about many topics all at once, and this is just a validation that cannot be ignored. Citi invests in stablecoin startup Bank Bunk as banks deepen in crypto ties. And let's not underestimate the cause here of all of this momentum behind stablecoins and banks adopting stablecoins and so on and so forth. And this is the Genius Bill, which passed. Now, it is no secret that the banks are lobbying pretty aggressively behind the scenes. They believe that there was a massive loophole that issuers can indeed reward yield if they just change the name from yield to things like rewards. But that being said, it has awakened the market's capacity to build, to create new yield-bearing opportunities, and in a true competitive market, it's just looking like crypto's got the edge. Now on to sweet Bitcoin, because that is the leader of all of these markets, and we've really seen this wild run happening from gold. And when I say wild run, I mean kind of terrifying decoupling of confidence in the fiat regime and like what the hell is going on with their money, because everybody's storing their money in cash and it's just not buying us goods anymore. Like coffee is running away, groceries, healthcare is insane, rent is spiking. However, is that gold rally something that's going to happen and follow on with Bitcoin and crypto? Obviously, the thing considered digital gold. Now, longtime Bitcoiners are starting to look at that gold rally and say, hey, like, what about us? When does this apply? And of course, we have Coin Bureau, a major resource behind Bitcoin and a lot of their metrics and information, things of that nature. And Nick Pukerin, one of their analysts, takes the point here that, hey, look, gold's rally has gotten really crazy. Since September, we're starting to see this hockey stick-like shape, and that he is taking the point of view that it's not really this panic moment as much as it is a momentum trade. That once gold started its run, a lot of traders, just understanding that we're in this era of instability, are just following on with gold. So citing that, look, if that is the case, if we're not actually running to the hills trying to take off all of our assets and put them into this shiny, bright metal, that in reality, Bitcoin and tokenized real assets, they should be undervalued. Because when you start to look at the numbers, we can see that crypto investment products hit a record 48.67 billion in 2025. So it is looking like the appetite is there. The numbers do speak for themselves. And what we're seeing in gold is just a more comfortable momentum play versus this new age, newfangled version of the same asset. So when I go on to Bitcoin archives, I posted this chart I like, hence I'm sharing it. Institutions have bought 944,000 Bitcoin in 2025. That's a hell of a lot of Bitcoin. That's 7x the year's mining issuance and already ahead of 2024. And let's remember, the mining issuance is mostly backdated. Most of the Bitcoin were mined in the past. We still have about 100 years or till 2144 or something to that effect till the last Bitcoin gets mined. But after having cuts back that issuance rate. That is what makes it kind of constrained. What they are saying here is simply demand is crushing supply. And let's look at it, right? If we're looking at institutional demand versus new supply, I mean, we have 2020 with it kind of finding a balance. And 2020 was an important year, just like now. That was the COVID year. That's when we got into the initial money printing. And the money printing is kind of what Trump wants to go back to. Ironically, he was the one to do it in the first place. Now, we can see that the institutional interest kind of waned as that supply continued to go, but then we hit a halving year, and now it is simply wildly disproportionate. So again, this comes back to the UDI thesis, which is that there's just not many Bitcoin to buy anymore, that OG Bitcoiners have sold a lot of them, that accumulation is becoming tougher and tougher. And of course, we've still got beautiful, sweet people out there working on Bitcoin tech to make it that peer-to-peer electronic cash that was promised in Satoshi's white paper. This is coming from Janessa Lopez. And here we can see New York, DC, former Senate staffer, current digital assets, AI, and emerging tech policy lead for Blocks, Cash App, Square. This is the same group of companies. They're all coming from that Jack Dorsey world. And what she's saying is, look, we want this new format for Bitcoin. And this is over Lightning Network, a layer 2 on top of Bitcoin. But it says, sellers can instantly convert card sales into Bitcoin. So super cool. Starting November 10th, sellers will be able to accept Bitcoin at the point of sale with zero fees. This is a huge boon to anyone that wants to take this. And let's remember, credit cards have baked into society the acceptance of a 2 to 3% standard fee for everything that we do. What the normal take on digital money is, a credit card swipe, is actually this highly debasing inflationary fee that is on everything that we purchase. So it says, look, these products are a big step towards making Bitcoin everyday money. They also highlight the need for a policy unlock. And this is the big CTA here, a de minimis tax exemption for everyday Bitcoin transactions. Your morning coffee should not trigger capital gains. We're building towards this future. And there is a YouTube here if you want to watch it. And by all means, dive in. Now, generally, the stance has been that Bitcoin transactions under $600 should not go into cap gains. They want to look at Bitcoin as a currency and not like a long-term investment kind of holding thing, which is really what it's gotten into. And that is because there's capital gains. And I would take this one step further. I don't think turning Bitcoin into, say, wrapped Bitcoin on the Ethereum network should also incur capital gains. That's absolutely crazy. You're representing the same value set of that underlying piece of information, which is Bitcoin, but you're trying to get it onto a different network. Right now, however, a lot of the issues with generating yield on Bitcoin is that you have to wrap your Bitcoin, move them to Ethereum, and at present, that technically is a taxable event. So that breaks a lot of smart contract DeFi platforms that allow you to earn yield on your BTC. Now, of course, in response to that, Senator Lummis comes right out and she says, look, she's working on a de minimis tax exemption for everyday Bitcoin payments. It's coming. So I don't know. Fingers crossed that we get to this. And then, of course, with Lightning Network, with Starknet, which just came out recently, we can maybe expand the utility behind Bitcoin to become this better savings account, this sort of inflationary hedge, as well as something that you can actually buy stuff with. And let's not forget that Fannie Mae and Freddie Mac may accept it as collateral for a mortgage. That cannot be understated how huge this is. But all of this allows people who believe in Bitcoin as a store of value to actually continue to live without having to sell that belief into dollars, right? Bitcoiners truly do not like dollars. So this is not only a philosophical hit, but there's also a cap gains tax on that. So it is kind of a blow. And when we sum this up, we got to look from CoinDesk. A majority of institutions expected to double digital asset exposure by 2028. And this is coming from State Street. State Street ain't no small thing. Tokenized private market seen as first major wave of blockchain adoption via a survey by State Street. So what we can see is that with this passing of crypto-friendly regulation, or I should really call it blockchain-friendly regulation, because stablecoins are the big push here, and they're not really what I would consider a crypto, right? They are issued, they can be clawed back. You're not in full sovereignty of a digital dollar under a stablecoin issuer. However, that being said, it's very clear that AI and quantum computing, viewed as key accelerators for investment operations, tokenized private markets, I mean, they are starting to see the true value in using blockchain to reduce fees, to increase finality, to build new financial products that no longer rely on these massive trust structures. And something that I cover here in episode 157, The Great Flippeting, is that we are just seeing blockchain and AI be responsible for these small companies hitting massive scale. So I talked about, look, JP Morgan's headcount was 317,000 and Tether's is 250. And Tether's market cap is right under JP Morgan and over every other bank. Now, the reason I find this interesting is because we're seeing it again, right? Coming from Suma Siva, Polymarket seems to be less than 50 people and is worth $9 billion. What a massively efficient company, Jesus Christ. But we're seeing this with Hyperliquid, who is also taking a commanding role on a very small team. This is going to continue to happen. And this is just that sheer power and that value unlock of blockchain. If we take away all the monetary elements of being able to pay for it or store your money, one thing that is absolutely undeniable is being able to build a small business whose scale is not in the employee base, it is in the automation of blockchain. So whether or not the crypto assets do adopt, right, whether or not all of these institutions pour in by 2028, we will absolutely see capital flowing into these tiny teams that run these large, highly scaling automated processes, and they're scaling on public chains. That is one of the coolest parts. The scale is not like all your data being sucked into some centralized entity that's going to weaponize it against you. I mean, we're seeing both Apple and Google take down applications around ICE and their locations and their identities, but that means that we don't get data freedom there. However, on Ethereum, on Solana, on the Bitcoin blockchain, not only are they scaling these tiny companies to allow many more people to access financial sovereignty, but they're doing it in a way that secures our rights. And that is super exciting and just increasingly bullish for not only the adoption of this technology, but obviously as it adopts, we should expect the price to go up with it. So as of now, if you're holding your dollars in your bank account, if that's your life savings, I mean, God bless your heart, but you are in a terribly dangerous situation. We're seeing the value of the dollar decrease 10% in 2025, with the same value decrease of 10% expected to happen in 26. This is why we're seeing prices go rampant due to the tariff issues. And it's just a very scary time to be earning dollars because salaries aren't going up, businesses aren't paying more, and they're selling you these dollars that if you just hold on to them, you are going to be actively losing money. So hopefully there will be a wave of crypto adoption moving towards just basic employees who want to earn yield on these stable coins if you don't want to get into speculative assets. But lo and behold, the value proposition for blockchain and everything it does is just increasing sector after sector. There's so many reasons why this is a superior mechanism. And of course, at some point, as Elon Musk is known to say, it'll be 3 times faster, 3 times cheaper, and just 3 times better of a product experience. With that being said, the markets are all over the place. We hit like the all-time high in the middle of the week. Now we're back down to 120K. So don't over lever. Leverage does not let you sleep well. As always, stay safe. Give me a like and a sub if you find this useful at all. I mean, I appreciate the world to anybody who takes the time to watch this. And as always, I will see you tomorrow.